Welcome to today's video training tutorial. My name is Ashley Jessen and I'll take you through today's training. And today we're going to have a look at one of our analyst trading strategies, and we call it the double golden cross MACD and stochastic oscillator trading strategy. Now this is a strategy you can look to employ across multiple time frames, and we do recommend that you backtest anything. But most of all, consider this a framework for your trading to consider some different entry ideas and maybe even some different exit ideas, especially if you haven't used these indicators before. Now in particular, for those of you who use swing trading strategies, you will find that this strategy will resonate quite a little bit with you, because ultimately what we're looking for is uptrending markets that are pulled back into oversold territory using the stochastic for a long entry, or downtrending markets that have popped up into overbought territory that we can look to short sell, or an opportunity to short sell at that point in time. So let's get a little bit more into it and see what is involved. Now when it comes to this particular strategy, we have what we call a trend gate. A trend gate is just the ultimate initial part that stops us from getting into whipsawed markets or entering long in markets that might be downtrending. And it's a very, very simple entry gate. It's a 200 period moving average, and we just want it for a long entry. We want it to be rising today compared to yesterday. Now the other indicators that we do use are the stochastic oscillator and the MACD indicator. So let me just jump into what the long entry criteria looks like. First of all, we are looking for that long-term moving average, the 200 period moving average, to be rising today compared to yesterday. That at least gives us an indication that the market that we're trading long is in some form of an uptrend. Now for those of you who know the moving average, you know it is very much a lagging indicator, and it is very slow to the party, so to speak. However, this is just an initial trend gate, as we were talking about a little bit earlier. Now the other side of what we're going to look for is the stochastic oscillator. For those of you that don't know what the stochastic oscillator is, it's looking at where is today's close in relation to the high and the low over the last 10 periods. And it is what we call an oscillator. It oscillates between overbought and oversold, and it's great for range-bound markets. However, some of the cons to this particular indicator, it can be quite sensitive, and in trending markets, because the market is always at the highest point in the last 10 days, you're going to constantly get an overbought signal thinking that you should short sell it, when in actual fact it's gone to a trending market. So the stochastic is quite poor at timing a trending market, so best not to use it in that case. So let's have a look at the MACD. Stands for the moving average convergence divergence. It is known as a trend following momentum indicator, and it does show the relationship between two moving averages. We do the 26 moving average, subtract the 12 period moving average, and then we have a 9 period moving average as the signal line. Now we've actually got a second moving average on the signal line, just as an idea to see if the market is choppy at certain times. And this will play a key part into the strategy for looking for entries long and entries short. So what we're looking at here, sometimes the issues that we will consider with the MACD that won't give us a positive signal is that the fast and slow lines are tangled together like that. So it's a little bit too choppy in certain times and very much uncertain. So we'll keep an eye out for that. The long entry is pretty straightforward. The 200 period moving average must be rising today compared to yesterday. As I said, it is a slow moving lagging indicator, but at least it gives us an indication that the market is in an uptrend to some extent. Not always, because it is slow to the party as it starts to tail down the other side. We are looking for the stochastic cross to appear in the oversold area. Once again, 200 period moving average rising, the stochastic is in oversold area and it's looking to turn. And then we're looking for the MACD golden cross, which is coming from under the midline and starting to track up to the midline. So, and the stochastic lines must keep the gap. We'll have a look at that in an example, and rising toward the midline as well. So essentially for those swing traders, uptrend, but the market has pulled back and we're now starting to see it turn the other way, but we're trying to avoid some of those areas that it's quite choppy. So this is your signal for your long entry. So as you can see here, the 200 period moving average in this case is rising today compared to yesterday. It's a very slow moving indicator. but it's a great trend gate for initially looking for uptrending or downtrending markets. And you can see if this market did in fact start to head down south, that 200 period moving average is likely to be very slow to actually give us that indication. But in trending markets, very, very handy. So in the MACD indicator here, you can see the signal lines. The MACD is crossing from below to above, and that's why the second moving average is on the 9 period signal line of the traditional MACD. And we can see the stochastic is coming from oversold, starting to cross up. We've got the cross is actually happening here, and it's moving to the midline. So that would be the signal for a long entry. Now, as far as the exit, what we do look for are the previous, some people call it a swing low if you're a swing trader, and we look for the previous low period. If we've got the entry criteria here, where the MACD crossed, the stochastic crossed from oversold areas, and then we would look back to the previous low and we would put our order for an exit below that level. Some people like to go one tick below that recent low just to give it a little bit of wiggle room, just in case it hits a perfect double bottom or a tweezer bottom there. Then that can actually maybe be a turnaround point where it's actually coming back. So we'll give it a little bit of wiggle room if that's what you like to do. And then in terms of the profit and loss and the risk reward ratio, ideally in this type of strategy you want at least a 1-to-1 risk reward, but ideally a 2-to-1 risk reward. So we've got two strategies. A short term, we might do a 1-to-1 risk reward ratio where we put we have a look at the size of the exit and we put our profit target at least one lot of risk away from where we would take our risk. But otherwise you can use a slight trailing strategy, you can use a MACD divergence, you can even use stochastic divergence to be honest, but you might also use a count back low where you might count back to the low of the last say 4 days, some people like to use 3 days, and just trail that stop up behind to give it the best chance of trending in your favor, and then you would take your exit in either of those scenarios. 1-to-1 risk reward, 2-to-1 risk reward, or you might like to trail that stop using some of those trailing criteria, or look for a divergence on the MACD or a stochastic. A little bit tougher to get into in this particular tutorial, but remember this is just a framework for you to consider. We can have a look at some of those divergence ideas a little bit later. Okay, so let's now have a look at the short entry criteria. It's just basically the opposite of the long entry criteria. So we keep it really simple. In this case, we're looking for the 200 period moving average to be falling today compared to yesterday. So we want to at least identify that there is a downtrend in place, and then we're looking for the stochastic or the market to be rallying up a little bit and the stochastic to be overbought to signal that there's a bit of a swing potential coming up in the market. And then of course the MACD, we're looking for the stochastic cross to be over in the overbought area, and the MACD from coming from above to below to the midline and coming back down. And that's pretty much the entry criteria for the short entry. Once again, similar to the long entry, we're looking for the stochastic to have the lines keeping quite separated. So a nice strong move up, heading to the midpoint, and also for the MACD, we're looking for that cross coming down towards the midline from that overbought region there. So they're the two, that's the long and the short entry, depending on the market that you're trading. The key here is for you to test this, to throw some ideas on a couple of charts, have a look at a few different time frames to see how it works on the euro dollar, maybe gold, or maybe the S&P 500, the indices. Certain markets do tend to perform a little better to it, and certain time frames as well. I wouldn't bring this down to too short a time frame, maybe an hour. Our other analyst likes this over 1 hour time frame, so do consider that time frame when you're testing. But for those who are swing traders, if you're used to swing trading daily charts, give it a go on that, back test it and see how you go. Always play around with your exits. The exits are really where you get to lock in the profit to see if you can have winning trades that are multiples of the risk that you're taking on, which means your risk reward ratio on that strategy is ideal. So keep that in mind when you're looking to build this or any part of this into your future trading strategies. Thank you very much. Hope you got some great information out of this and you're able to apply some of the strategies, and we look forward to seeing you in the next tutorial. Thank you.